Alright, so Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I'll be your instructor for today's accounting session of the paper Strategic Business Reporting of ACCA. So today we are going to discuss about one very important accounting standard, which is IFRS 2 share-based payment. It is one of the newer accounting standards that students may have not covered under the previous reporting paper of financial reporting ACCA. So this will give you a very good chance, this lecture will give you a very good chance to have a solid understanding of this accounting standard. And also this is one of the mostly tested accounting standards in the SBR exam. So without any further ado, let's begin. So IFRS 2 is known as share-based payments. Now, I always say to my students that if you really want to understand an accounting standard, start by decoding its name. Firstly, you need to understand why IFRS 2 is named as share-based payments. So the accounting standards starts by explaining what does share-based payment mean, what is covered under the purview of share-based payment. It says that share-based payment is an arrangement where entities receive or acquire goods or services in exchange for equity instrument. What do you mean by that? So let us say there is a company, ABC company we may call it, and this company acquires goods or services. I mean, by goods, it can be some sort of trading goods. Let us say we call it inventory, or maybe, tangible assets like plant and machinery, or maybe services like employment services. All right. So ABC company receives inventory or plant and machinery or equipment or employment services, any good or services. And when the time comes to settle these transactions, and for example, the counterparty is XYZ company, the other party, or you may call it our supplier. When the time comes to settle this transaction, ABC company settles these transactions in the form of an equity instrument. In a very layman term, equity instrument may be known as a share in very layman terms. So what do you understand by this? Share-based payment transaction is any transaction, any arrangement, any example, or any scenario in which one party acquires goods or services and settles that transaction in the form of shares. It pays the other party in the form of shares. All right. Now the standard continues. The standard clarifies one more thing. Any transaction in which one party acquires goods or services and settles that transaction in the form of an equity instrument or cash but cash which is based on the value of equity instrument prices, that is based on the value of shares. So even if an entity settles its transactions traditionally, like in the form of cash, but that the amount of cash is based on the value of shares, that transaction is also covered within the scope of IFRS 2. So if you really decode the name of the accounting standard, it says not share payments but share based payments. So all of the students, I would want you to pick up your hand and repeat after me. Just learn, just get the feel of the accounting standard. IFRS 2 covers such a transaction in which one party acquires goods or services, and in exchange of goods or services, either it pays in the amount of equity, shares, or based on some cash which is actually valued based on shares. So any transaction of this sort is known as an IFRS 2 transaction, a share-based payment transaction, or we may call it shortly SBP. All right. So, share-based payment is becoming more and more common nowadays. If you talk about tech companies, if you talk about startups, if even if you talk about some bigger companies, you know nowadays you realize that cash is king. Many of the companies are indebted towards their finance providers. They may have not very much runway available in terms of cash. And it can be a possibility that the investors of a small or a large organization requires the organization not to spend so much cash. Now this organization wants to grow, it wants to reach out towards the masses, it wants to reap up the benefits of the demand that is coming in, but it cannot grow if it doesn't have enough cash. Now in these type of situations, the entity can rather offer the supplier a payment which is in the form of shares, or maybe at a later date it can be cash based on the value of shares, so that such a transaction is lucrative for the supplier. It accepts that when the entity grows, its share price grows, and then I can get cash, which is basically equivalent to the amount of shares, right? Equivalent to the value of amount of shares. So these type of transactions are becoming more and more common, and your SBR's examiner is testing it more and more commonly. Now the standard one clarifies one thing further, and that is that amounts that are paid in cash or other assets of the entity. That is, the standard clarifies that there may be a scenario that the entity may pay in kind, like bartering another asset of the entity, some investments of the entity, or maybe another equipment of the entity. There is a possibility. So any transaction which is settled in the way of shares, or cash based on the value of shares, or something in kind but which is based on the value of shares, such transactions, such payments which are based on shares, are known as share based payments. All right. So I'm very much hopeful that you get a good feel of the scope of this accounting standard. Now, moving on. If you really want to get an edge in this accounting standard, I would want you to get a hold of these certain 7 or 8 terminologies that we are going to discuss right now. And I'm very hopeful that if you get good command on these 7 to 8 upcoming terminologies, it will be a very good omen for you and you will excel in this accounting standard, and ultimately your paper as well. So let's start with our first terminology. Our first terminology is that you need to understand a term which is known as share options. Now, I've seen many students, I've seen many professionals that whenever they, hear this term options or share options, they often get confused that we are going to study something which is very technical and we won't be able to get good command of it. I disagree. Now, share option is not a technical term, so to say. It is just a contractual agreement that promises the holder some equity or some shares. So, I'll give you a hypothetical example. So, for example, this is a person, a very smart person. His name is, for example, YY. You understand who I'm talking about. So, there is a person who is YY, and there is another company, for example, it is ABC company. Now, this ABC company comes to YY and says that, Mr. Yasir, why don't you come with us and provide us your accounting services? And you be exclusive with us. You don't provide any services to any other person, and you be exclusive with us, and we will grow together. I say, whoa, wait, 1 second. Can you really afford my services? You are just a startup, you are just a small company, or you are a very large company but you don't have enough cash. I see it in your balance sheet. How are you going to pay me? So this ABC company comes and gives me a very lucrative offer and says, Mr. Yasir, don't worry. If you really work with us and you promise that you'll work with us for another 3 years, exclusively with us for another 3 years, we will give you, for example, 500,000 shares. All right. So if you really understand the transaction. It is one company offers me an employment for 3 years, an exclusive employment for 3 years. And when I ask for payment, how are we going to settle this transaction? It says we are going to give you 500,000 shares, which is more or less equivalent to, for example, 3 or 4% of this company. And that you will be a shareholder of this company. You will be an owner of this company if you work with us for another 3 years. For me, it may be a lucrative option. Okay, I get to be the shareholder of a very good company, a 3 to 4% shareholder, and just by providing my routine accounting services, my routine employment services, for me, it can be a very lucrative option. But wait. As a professional, I should say, okay, ABC company, I agree with your transaction. I agree with the terms of payment. I agree with this scenario. But wait, shouldn't we write this on a piece of paper and make an agreement of this transaction? Right? So every sane person would say, okay, we can write these terms and condition on a piece of paper and let us agree to it. Let us both sign on it and agree to this transaction. Now, this agreement on which two parties agree that in exchange of certain amount of goods or services, one party is going to pay another party some amount of shares in exchange of some services. This type of agreement is known as share options, commonly known as SOPs. All right. So basically, share options, or I routinely call them SOPs, are, is not a very technical term. SOPs is just basically a piece of paper which guarantees the holder of that agreement, holder of the SOP, that in exchange of certain conditions, in exchange of certain services, you will be settled in the amount of shares. All right. So share options, it is a very simple term. It is just a piece of paper and agreement, nothing else. All right. Do you agree with that? Now we are done with the first terminology. We can move forward. The other terminology that I would want you to learn is basically the terminology of exercise price. Now, basically, an exercise price is basically a nominal price which the holder has to pay when he or she exercises their option. So, for example, in our scenario, I was told that if I work for 3 years, I'll be paid in the form of 500,000 shares after 3 years. Now, after 3 years, when I go to this company and I say that, see, I had an agreement with you, here is the SOP, I want to exercise my option, give me my payment, give me my 500,000 shares. So it is a common practice in this industry, in this type of instruments, that the holder, when exercising his or her option, has to pay a nominal price. For example, let us say 0.5 per share option, a nominal price when exercising his or her option. So basically, exercise price is a nominal price that the holder has to pay when the option is exercised. Now, many of the students have asked me, why do these instruments have an exercise price? Why do we pay a nominal price? For example, share at that date is worth $10. In order to get those 500,000 shares worth $10, I have to pay a nominal $0.5 price to ABC company. But why? Why is there an exercise price in such type of contracts? So one justification I may give you is, you know, when we were younger and we used to study our corporate law paper in basically this accountancy, we used to learn that in order to make any contract valid, at least three conditions must be present, right? So any agreement is covered under contract law in which there is an offer, there is an acceptance, and there is some sort of consideration. One logic that we see of including exercise price is that exercise price also also serves as a consideration in this agreement. Obviously the services are also a consideration. In on my part, I'm providing my services to ABC company, that is also consideration. But in order to fulfill what I feel in order to fulfill the criteria of contract law, and maybe to make this share option a valid agreement, an exercise price is included, so that it comes into the purview of law as well. It becomes a legit legal and accounting a legit accounting transaction, and also a legal transaction. All right. So and you don't need to really worry about the excise prices, because these are very nominal, and obviously anyone would be able to paying it. Right. So in order to get those shares, the amount of payment that you need to get. All right. So the third terminology that we need to focus on is basically something known as grant date. So grant date is basically the date on which option is agreed and accepted. So for example, ABC company came to me on year 0, let it be any date. ABC company came to me on year 0 and offered me that if you work with us for 3 years, we will provide you certain amount of shares at the end of 3 years. We are entering into a share based payment transaction. So the date share options are offered and accepted, the starting date, the first date this transaction comes into being, that date is basically known as grant date. So again, I'll repeat, what do you mean by grant date? Grant date is the date when options are granted. Grant date is the date when this type of transaction is offered and accepted. It is the commencement, it is the initiation of the transaction. Grant date is point zero, point not, point initial, point commencement. All right. Now, if you understand this grant date, there is one more terminology that you need to understand, which is vest date. I'm just skipping one row and we are talking about vest date. What do you mean by vest date? If grant date was the date when options are granted, vest date is basically the date when the holder becomes eligible eligible to exercise their option. All right. Grant date is the date when share options have been granted. That Mr. Yasir, you need to work with us for 3 years, and after 3 years, we'll pay you in the form of 500,000 shares. The date in which this transaction is initiated, that is known as the grant date, and the date on which I become eligible to exercise those options. In my case, I had to become eligible after 3 years. The date I become eligible to exercise my option, in this condition, it was 3 years. The date at which the holder becomes eligible, it fulfills the conditions mentioned in the share option, and when those conditions are met and you become eligible to exercise those options, that date is known as the vest date. That date is known as the vest date. So grant date is basically, for layman terms, grant date is the starting date and vest date is the ending date when you become eligible to exercise your options. All right. Now, one more thing that we skipped earlier is vesting conditions. What do you mean by vesting conditions? Vesting conditions are basically those conditions that must be met for eligibility of exercise of options. You see, in my case, vest date was year 3. And why was vest date year 3? Because and on that date, I had fulfilled the condition and now I was eligible to exercise my option. Now, the conditions that must be met in order to become eligible for exercise of option, those conditions are known as vesting conditions. Vesting conditions. What are vesting conditions? Vesting conditions are conditions that must be met in order to become eligible to exercise your option. So, one is grant date. Grant date is the initiation of the transaction. The holder has to fulfill the conditions over time. And when that condition has been met, the vest date comes and you become eligible to exercise your option. In my case, what was the vesting condition? I had to stay in employment. I had to stay in employment for 3 years. That was the condition with me. But one question that may be arising in your minds at this moment of time is the vesting condition always 3 years? No. Vesting conditions are specific to the agreement that the parties had. For example, uh, if you ask a supplier that you have to deliver me this plant and machinery and then I'll pay you in the form of shares, what is the vesting condition? The condition is that the supplier must deliver you a certain type of plant and machinery. That is the vesting condition. And when that condition is fulfilled, that is when the plant and machinery is brought to your factory and installed and it's working fine, the condition has been met. The condition has been met, and there comes the vest date. All right. So five types of terminology we have studied right now. Share options, an agreement in which the holder is guaranteed some amount of shares in exchange of certain conditions. There is an exercise price, which is a nominal price which has to be paid at the time of exercising your option. Grant date is the date on which this transaction is basically started. Then some conditions must be met. Those are known as vesting conditions. And when those vesting conditions have been met, there comes vest date. Vest date is the date the holder is eligible to exercise his or her option. Now, one thing that we need to clarify here, and you shouldn't misunderstand what I'm saying here. Ask yourselves a question. Is it possible, is it, or I may say, is it really necessary that a holder exercises his option on the vest date? Is it necessary to exercise your option on the vest date? The answer is no. The actual exercise date may be after the vest date. You see, the vest date is the date you become eligible to exercise your option. But is it mandatory that you exercise your option on that day? Not necessarily. Now, some type of share-based payment, share option contracts may require that once you become eligible, you will have a 1 year period to exercise your option. So the holder may say, okay, I became eligible on year 3, but I will be exercising my rights on year 4. I will arrange the amount of exercise price required and then I will exercise these options. It is a good possibility. But it is all up to the agreement that the parties had. If, for example, if the contract had required that the holder must exercise his or her option on the vest date, then that may be the case. But it's not necessary. Exercise date may be after the vest date. All right. Ask yourself a question: can exercise date be earlier than your vest date? Can your exercise date be here? The answer is no. Exercise date cannot be before the vest date, but it can be anytime after the vest date. It all depends on the type of contract that the parties have made. Now, one more condition that I would like you to understand. And this type of terminology is vesting period. What do you mean by vesting period? Vesting period is the period in which conditions should be met. For example, in my case, if someone asks me what is the vesting period, I would say 3 years. So for example, you remember what the other company told me? The other company told me that you have to work with us for 3 years and then you will be eligible for 500,000 shares. The period which is taken, the period which is required, the period which is taken to fulfill the conditions of that option, that period is known as vesting period. In my case, it was 3 years. All right. One more terminology, and this is one of the most important terminologies that you need to understand. Most important. Just focus on what I'm saying. This terminology is known as intrinsic value. So, what does really intrinsic value mean? Intrinsic value, by definition, means the amount of maximum benefits, that you can extract from a particular instrument. Intrinsic value means the amount of maximum economic benefit that you can achieve from a particular instrument. Maximum benefit. So for example, if someone asks me that, Mr. Yasir, what is the intrinsic value of your option that ABC company offered you? What is the maximum economic benefit that you will have from this particular option? So I would say technically what is going to be the maximum benefit. So in exchange of my services, I am going to get some options, and those options, those shares will have some fair value. So for example, I just for the sake of it, I say that I've considered that these 500,000 shares that I'm going to get will have a fair value of $10. So for example, today the options that I have, the shares are valued at $10. So from this option, I'm going to get shares, and each share is, for example, in the market, it's worth $10, fair value of share. I'll repeat it again. If someone asks me, Mr. Yasir, you have been given one SOP of ABC company, what is the intrinsic value of that option? What is the maximum benefit that you are going to get from that option? I would say this one SOP is equal to one share, and the fair value of the share is, for example, $10. I'm just taking an example, $10. So what maximum benefit I'm going to get? I'm going to get a $10 value share. But don't I have to pay a certain amount of exercise price in order to get this $10 share? So I'm going to subtract the exercise price. In my case, for example, it was $0.5. So what is the maximum amount of economic benefit that I may get? It is $9.5 today. So if someone really asks me, what for you is this one SOP really worth? I would say, for me, the real value of this SOP today is its intrinsic value, which is today calculated as $9.5, because I'm going to get a $10 share, but I have to pay $0.5 as exercise price. So for me, it's today it's worth at $9.5 after exercise price. All right. These share options that we just talked about, the agreements, these are tradable into the market. These are tradable in market. More likely they are tradable in market. If these share options are tradable in market, they must have a market value, right? If share options are tradable in market, they must have a market value. And if someone asks you, what what is the market value of share options, then what is going to be your answer? Okay, I have a certain, you may say that I have a certain, for example, share option. I can trade it into the market. What is the value of this share option in the market? What is the value? So the answer is that ideally, the market value of a share option should equal to its intrinsic value. What? The answer is the market value of share option should be equal to its intrinsic value. Wait. Sir, we don't actually understand what you're trying to say. You're saying the market value of a share option should be equal to its intrinsic value. But sir, how do you come to this conclusion? You see, market participants value anything based on the maximum amount of economic benefits that they can get from a particular instrument. So, for example, if I go to a particular market participant and I say, you see, I have a share option of an ABC company. Would you like to buy it? Now, how is that person going to decide if he wants to buy it or not? He is going to check what amount of maximum benefit that he can get from this share option. And what amount of maximum benefit he can get from this share option, what he is going to do is he is going to calculate intrinsic value, the maximum economic benefit that he can get, and that is going to be the value of share that this option can guarantee, fair value of share $10, and he's going to minus the exercise price because he would have to pay the exercise price, and the maximum economic benefit that he would have is 9.5. So for a market participant, the market value of a SOP should equal to intrinsic value. If I get the opportunity of showing you this same thing in the form of a graph, I'll just make a graph. Please see. So, okay. So for example, I make a graph. So this is a graph. If someone asks me how should the market value of a SOP be represented, I would say this should be the line. I wanted to make it much more linear, but this is the best I can do. So the market value of a share option should be equal to intrinsic value. This is the graph that we should be making. It's one and the same thing. Market value should be equal to intrinsic value, but that is ideally. Now what if I tell you, now this is very interesting, please listen. What if I tell you, my friends, that ideally market value should be equal to intrinsic value, but often this is not the case. Often, what is the market value in terms of intrinsic value? Often, here is the market value. Ideally, market value of a share option should be equal to intrinsic value because any market participant would want to value this share option maximum based on the economic benefits that he can have from this share option. So we would be, calculating, okay, this share option, I can get a share against it. The share price is $10. I'll be paying excise price of 0.5. So, okay, I would having an economic benefit of 9.5, which is the intrinsic value, and that should be the maximum worth of this share option. But often in markets, often this is the case that the market value of a share option is basically higher than the intrinsic value. Now you might be wondering, why would that be? For example, if we have calculated, that the intrinsic value is 9.5, if we have already calculated that the intrinsic value is 9.5, why would the market value be, for example, $11 or maybe $12? Why would this case be? Why would market value be higher than the intrinsic value? Why would someone pay 11 or $12 for a $9.5 economic benefit instrument? Why? Why? You know why? This is because of expectations. Expectation. If a buyer comes to buy this share option and he calculates that the intrinsic value is 9.5 today, even then he may be willing to pay you $11 or $12. Why? Because the buyer may be expecting that, see, this instrument is going to, the vest date is going to come after 3 years. 3 years. We are standing here, and the vest date is going to come after 3 years. There is a possibility that the share price in these 3 years may go to, for example, $13, $14, $15. There is a possibility that the company progresses and the share prices go up. So, for example, even if the intrinsic value of this option is 9.5 today, but since the share price of the company can go to a higher level after 3 years, why, even if I get this option for $11 or $12, it will be a viable transaction. All right. So basically, due to expectations, market participants may be sometimes overvaluing, valuing above the intrinsic value, a share option. They may be valuing higher than what the intrinsic value is. So the graph may be going above the basically intrinsic value curve. The expectation effect included in the market value of the option, in our terminology, this is known as time value. Now, this is not time value of money. Okay, so don't be too quick in judging. I'm not talking about time value of money. This is time value. So basically, what time value is, time value represents the expectation of a market participant. Excuse me. Time value basically represents the amount of expectation of a market participant that the price of the share may ultimately go up, and even if I buy this particular option at a higher price, the share price is going to be much higher in 3 years and I'm going to get a benefit out of it. It's a positive time value effect, and due to this time value effect, the market price of an option may be reaching higher than the intrinsic value at that date. It is possible. One more thing. If you really look at the graph, you see at the vest date, the graph actually comes equal. Just look at it, how fascinating this is. On the vest date, or I may say on the exercise date, to be very particular, on the exercise date, the graph actually matches. Market value becomes, by all means, on the last date of the transaction, the market value will equal to intrinsic value. The graph has to come back. The curve has to come back. Why? Because just think technically. If you're standing on the last date, you see, before you had an expectation that since the option is going to mature after 3 years, the price may go up. But once you reach the exercise date, it is the final date. Now there is no more future that we are talking about. It is the last date already. So if you're already standing at the last date, my friend, there is no further expectation. It is already the last date. The intrinsic value of today is the maximum economic benefit that you will get because it is the last day. So the market value will equal to intrinsic value on the exercise date, on the vest date, on the last date. All right. One more thing that may be coming into your mind, and before you even say that, I'm just going to put it myself. Is it a compulsion? Is it really a compulsion that there should always be positive time value? Is it a compulsion? No. There can be a scenario when there is negative time value. Yes. So the holder may, the market participant may also think, okay, this basically this share option is worth $9.5 now, but I don't think this company is going to go anywhere in future. I know when the time comes, it when it matures, the share price is going to be much down. I see it from imperative evidence. For example, if I see 52-week performance, the share price already had been going down. It will go down, and Yasir, if even if I buy it, I'll be at a loss. So for me, for example, I'll pay for this $6. And I tell him, no, 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 no. How can you pay me $6 for this share option? It has worth of $9.5 today, but the buyer is the market participant is going to say, Yasir, that's okay, it has intrinsic value of $9.5 today, but I see that the company is not going to perform that well, and obviously the share price will go down, and by the end of 3 years I will see that I won't be getting a good return. So for me, since the share price would be going down, I'll be paying just $6 or $7, and that would be enough for me. So the point I'm trying to make is the market value may even go down from the intrinsic value. The option may be trading below the intrinsic value, and which may be primarily due to negative time value effect, that is negative expectations of the market participant. All right. So we also understand what is intrinsic value, but I'm again saying at the closeout date, at the maturity date, the market value has to equal the intrinsic value. The fair value should be equal to intrinsic value. That is a must thing. We are going to see at some questions in which we see that on the last date, the examiner has either missed out the market value or either missed out the intrinsic value. And at that point in time, it is going to be very obvious that you should remember in your mind that, okay, fair value is equal to intrinsic value, or intrinsic value is equal to fair value. You just have to work that out when we are going to see that question. All right. So this is it. Okay, so before we actually conclude this introduction session of IFRS 2, one more thing that you must learn about. See, it's an important note. You see, there may be a scenario that employees are being paid some shares. This has also come into a past paper, and we are going to see that past paper as well, I hope. You see a scenario in which your employee is being paid some shares, but if he or she is being paid some shares, but in the capacity of being an existing shareholder. For example, I think you must have studied some things, for example, in Code of Corporate Governance, right? So, for example, as per the Code of Corporate Governance, it's often said that CEO must have some shares. For example, there is CEO of a company who, by the compulsion of law, has 100 shares in the company, just 100 shares in the company. All right. So he is an employee of the company, is working for the company, is providing employment services for the company, but due to the requirements of law, he has 100 shares in his pocket as well. He is a shareholder as well. Now this company announces a bonus issue. All right. So if the company announces a bonus issue, some extra shares are also going to the CEO. But here you need to identify, clarify, and understand that this time your CEO is going to get some extra new shares, but he's getting those new shares not due to a vesting condition being fulfilled, not due to the fact that he was providing employment services to the company. This is not a share based payment transaction. He was paid shares just because he was also a shareholder as well. So since he was a shareholder, he got new shares in the capacity of being an existing shareholder. That is not share-based payment. It's just a bonus issue transaction. It's not share-based payment. Share-based payment is a scenario in which the company receives goods or services, and in exchange of those goods or services, shares are being paid. That is a share-based payment transaction. This type of transaction, bonus issues, right issues, and some of your employee are already shareholders and they get some new shares, this is not within the scope of IFRS 2. All right. So my friends, we have put in so much time, we have put in so much time and effort, and I thank you. I hope this is a very good introduction session for you. It will give you lots and lots of support in future. All right. So we'll just call it here for this lecture, and I'll see you in the continuing lecture. Thank you.